It was a disappointment for many when the Reserve Bank failed to cut interest rates last month. The bank's pause left the prime rate at 10.25%. It argued the inflation forecast was riskier compared to the previous monetary policy meeting. In its latest review, the Reserve Bank reiterates that the country's economic stagnation is largely due to weak exports, higher household debt and poor investment due to uncertainty. The Reserve Bank governor says the perceived inaction on corruption is affecting investment.
Our failure to act on corruption might be giving a wrong signal that we actually do not treat this thing seriously. And you could see it that the fact that there hasn't been action looks like it is also affecting business confidence, it's affecting consumer confidence, and it raises very important questions about the rule of law.
The latest review also points to the growth divergence of South Africa when compared to global growth. Between 1996 and 2016, South Africa's output increased by just under 1% when the global economy grew by 1%. But our domestic structural issues have now taken us out of sync.
The structural change that needs to get going as a matter of absolute urgency is an improvement in educational and training outcomes, especially in areas such as language facility and maths and science. Without that, South Africa will not be able to produce the goods and services that its population needs. That in turn will render it totally reliant upon imports from abroad, and then lends itself to the perception of colonization.
Emphasizing the need for structural change, the bank says even if confidence and commodity prices were at their long-term averages, the country's growth would still have been around 2% last year. That's not nearly close to the 5% needed to create jobs. David Murrigan, SABC News, Pretoria.